Around the world, central banks are buying gold at a pace not seen in half a century. It's not a coincidence. This is about strategy, and it's reshaping the foundations of the global monetary system. The last time we saw accumulation like this was in the early 1970s, when the United States ended the direct convertibility of the dollar to gold. That decision cut the last tie between paper currencies and precious metals, forcing nations to adapt quickly. Some stockpile gold to hedge against uncertainty, others to signal financial strength. Today's wave of buying is different in context, but similar in its implications. It's a signal that those who manage national reserves see something coming. Gold is unique among reserve assets. It carries no counterparty risk. It's universally recognized, and it can be moved across borders without relying on another nation's promise to pay. In a world where sanctions, payment freezes, and currency devaluations can happen overnight, that independence has become valuable again. The question isn't just why they're buying, it's why they're buying now. Over the past decade, the balance of power in global trade and finance has been shifting. Emerging economies have grown their share of world GDP. New trade blocs like BRICS have pushed for alternatives to dollar settlement, and geopolitical tensions have made diversification more urgent. Gold sits outside the control of any one government, making it the ultimate neutral asset. Some reserve managers will call it prudent diversification, but that's only part of the story. That's true, but it's not the full story. Gold plays another role in times of transition. It's a trust anchor. When confidence in the stability of the system is questioned, holding more gold sends a message: we are ready for what comes next. In recent years, central banks in countries from China to Poland have been steadily adding to their reserves. The World Gold Council's data shows that official sector demand has remained strong even as prices hit record highs. That's unusual. Historically, buyers tend to slow down when prices peak. This time, the appetite hasn't faded. That suggests the motive is strategic, not speculative. There's also a structural shift in how reserves are being managed. A growing share of trade between certain nations is being settled in local currencies, reducing the need to hold as many U.S. dollars. As that happens, reserve portfolios can tilt more toward assets like gold without disrupting day-to-day liquidity needs. It's a quiet but meaningful change in how global reserves are balanced. Think of it as a hedge against systemic risk. Not in a doomsday sense, but in reserve management. If a payment network becomes unreliable, if a currency faces sudden sanctions, or if inflation erodes purchasing power faster than expected, gold remains outside those forces. It may not generate income, but it preserves optionality. Another reason this accumulation matters is the message it sends to markets. When central banks buy gold in volume, it can influence sentiment beyond the bullion market. It can signal caution, a reevaluation of long-term strategies, or a subtle move toward multipolarity in finance. Traders, portfolio managers, and policymakers take note. The parallels to 1971 aren't perfect, but they raise questions worth asking. Then, as now, the world was recalibrating its monetary order. The gold buying we see today might not precede an immediate, dramatic policy shift, but it fits a pattern we've seen before. When the rules of the game look set to change, those with the most to lose prepare quietly. So what's the practical insight here? Pay attention to what central banks do, not just what they say. Watch the flows into hard assets that don't rely on any one nation's stability. Understand that these moves are part of a long-term play, not a short-term trade. If you follow these shifts early, you can anticipate where the pressure points in the system might appear. You can identify the assets, sectors, and regions that stand to benefit from a tilt toward harder, more neutral forms of value. And you can position yourself before the changes are obvious. That is the edge of reading signals early. One reason gold has held its place for thousands of years is that it solves a problem no other asset solves quite as well. It bridges trust between parties that may not fully trust each other. In a multipolar world, that role becomes more important. Parties can disagree on policy, but still agree on the value of gold. This is one reason why countries with very different systems and priorities are making the same move. Consider how the post-World War II order was built. The Bretton Woods Agreement put the dollar at the center, but it was gold that gave the system credibility. Once the dollar left gold, credibility shifted toward the size and stability of the U.S. economy itself. Now, as trade patterns and alliances evolve, we are seeing an echo of that earlier reliance on a neutral anchor. Another factor is the evolution of financial infrastructure. In the last decade, new rails for instant payments, currency swaps, and settlement have emerged. These systems reduce friction, but they also introduce questions about control and access. Gold requires neither a messaging network nor a counterparty's permission to move. It operates entirely outside the plumbing that carries digital payments, and that makes it valuable as a backup. This accumulation is also a hedge against shifts in reserve composition. If a central bank expects that its holdings in certain currencies may become less liquid or more politically sensitive, gold becomes a way to store value without exposure to those risks. It's about balancing them with something no one can freeze or default on. Look closely at where the largest recent purchases have come from. Some are in regions increasing trade with partners outside the dollar zone. Others are in countries facing elevated geopolitical risk. Both sets of actors are using gold to create optionality, the ability to adjust quickly if the environment changes. Gold also serves as a quiet form of signaling in international relations. A steady accumulation can be a way to project resilience without making any overt political statement. It communicates preparedness in a language that markets understand, but that doesn't escalate tensions. The deeper you study the pattern, the clearer it becomes. Central banks are not trading gold for short-term profit. They are positioning for a landscape where trust will be distributed, power will be shared, and resilience will matter as much as returns. In such a world, the assets that survive policy shifts and geopolitical shocks will be the ones most valued. The point here is not to predict a repeat of 1971. History rhymes, but it rarely repeats in full. What's repeating is the instinct of major players to strengthen their balance sheets amid uncertainty. The tools evolve, the technology evolves, but the strategic logic is timeless. Watch the flows, study the motives, and think about how the same principles might apply on your scale. You don't need a vault full of bullion to benefit from the mindset that drives this behavior. You need to understand what it means when those with the longest time horizons choose durability over yield. Gold is not the only story, but it is a story that connects the past to the future of money. It's a reminder that in every era, there are assets that stand apart from the rest, not because they are fashionable, but because they serve a function no other asset can. If you take one thing from this trend, let it be this: stability and flexibility are not opposites. The most resilient players build both at the same time. That's what central banks are doing quietly, and it's why the rest of us should pay attention. If this perspective helped you see the bigger picture, subscribe to Wealth Signal so you never miss the next strategic insight before it hits the headlines.